Hey, what's going on everyone? It's Griffin here, and in today's video we'll be going on year number 4 of updating you all on the Wealthsimple Invest Portfolio that I've maintained over these past several years, really for this very purpose. Now it's crazy to me that it's already been 4 years we've been making these updates on the channel, starting back in 2018, right? And the last update that I made for you all was in November of 2021, so nearly a year ago at this point. But considering everything that's going on in the markets over the past even just 12 months, well, I thought it would be really fitting and suitable to make an update on, once again, the Wealthsimple Invest Portfolio that I've maintained for everyone who's been following along over the years. So as always, I really hope you enjoyed today's video. If you do, please take a second to drop a like. It really helps the channel out, and don't forget to look at all of the links and resources down below in the description. In fact, I recently just launched a brand new dividend growth investing course that I released over on Skillshare so that everyone can access it for free on a 1-month free trial, right? With this course specifically, I wanted this to be information that as many people as possible can consume if it was of interest to them. So make sure you go check out that new dividend growth investing course and the full stock market investing course, both of which on Skillshare, link down below in the description. All right, so quickly here before jumping into the screen recording of my Wealthsimple Invest account, well, if you're not familiar with Wealthsimple Invest in the first place, think of it as a robo investing platform where it's going to create an investment portfolio of exchange traded funds on your behalf based on your investor profile, your risk tolerance, as well as some other inputs. And by the way, as with all of these yearly updates on this portfolio, I wasn't paid by Wealthsimple in any way, shape, or form to make this video and all of these updates. This is just something that I started doing years ago and wanted to maintain for everyone who was interested. Now, with that said, Wealthsimple was one of the first companies to offer this type of robo ETF portfolio service years back. In fact, this was their first product offering on which they started the company. Now, of course, as companies do, they've expanded into a full suite and product line, including Wealthsimple Tax, Wealthsimple Crypto, and most popular Wealthsimple Trade. But really, that ETF portfolio product was their first offering. Since then, there have been many competitors that have entered the space both in Canada as well as the United States. Some of the larger ones include Wealthfront in the US and Questrade here in Canada. I've chosen to just stick with the Wealthsimple Invest Portfolio, really because I'm genuinely curious to see how this plays out over the years in parallel to, say, just the S&P 500, which makes up a large portion of my other passive ETF portfolio in my other accounts. And finally, a couple of other quick things to consider here. The fees charged by Wealthsimple are going to differ depending on the size of your portfolio. So an account with a balance below $100,000 will come with a 0.5% management fee. Now, when your account grows to over $100,000, then your yearly management fees drop down to 0.4%. So basically, since my account is below that $100,000 threshold, as we'll be seeing shortly, well, I'm paying 0.5% yearly management fees. And for the sake of example here, on $10,000, that would represent $50 in fees annually. Okay, so let's jump into my account here and we'll see what has happened over the past year, how the account has fluctuated. Now, just for some preliminary context and reference points, last year when we did this video, the account balance was sitting at $10,694, which was up 13.8% all time. And that was after switching to a 10 out of 10 risk tolerance on that account, up from a 4 out of 10 risk tolerance. And that was roughly a year prior, if I remember correctly, meaning the positions are now at like 90% equity and 10% fixed income, as we'll be seeing shortly. Since then, though, I have not touched this account whatsoever, other than adding roughly $5,000 for the 2021 tax period. Okay, so jumping into the account here, when you first log in, this is probably a common site for you. Looking into the managed investing, that'll bring us to the invest account. All right, and we can see 27,700. That's because I also transferred over a Lyra though. So we're going to be concentrating mainly on the RRSP right here. So I'll click on that and we can see right off the bat that the account balance is sitting at $13,907 for total returns over time of negative 4%, which equates to negative $575, which at first glance really doesn't seem all too good, right? Considering the fact that this is a portfolio that I've had open for several years at this point, but there are some things to consider. All right, so first and foremost, we'll take a look right here. We can see, as I was mentioning earlier, the risk level is at a risk level of 10, meaning a growth portfolio. So if we click on change, for example, we can see how the portfolio would fluctuate on average depending on the risk level. So because I'm pretty young and I'm looking to invest long-term in this portfolio, I put it on a risk level of 10. And what ended up happening with that is that it changed the portfolio composition to now 90% equity and 10% fixed income and gold. Now, if you want a bit more context about what these actually break down to on a per holding basis, basis? Well, we can click right there and see the portfolio holdings section. So in the equity section, for example, representing 90% of the portfolio, roughly 29% is in US equities, 21.5% in international. I'm not going to name them all, you can see right here, but the smallest position is actually in Canadian equities at 11.3% with the QCN ETF, which is the Mackenzie Canadian Equity Index ETF Series E. Now, if you click on it, it'll actually bring you to the ETF facts for each one of those ETFs, but just for the sake of this video, we're not going to be looking at each one of those. Now, that being said, if you click on the little drop down, it will also show you the fee associated with each one and a little bit of information about it. So we can see that this ETF, for example, has a 0.04% fee, which is very low. The US equity, being VTI, has a fee of 0.03%. International equities 0.07. So these are all ETFs that have a relatively low management expense ratio, with the highest one being the emerging markets at 0.25%. Even still, that is actually among some of the lower ETF management fees considering an emerging markets ETF. Now, if we scroll down, we can also look at the fixed income and gold positions representing 10% of this portfolio. And at 6.9%, we have the ZFL ETF, which is a long federal bond index. Now, bonds have not been performing well whatsoever, even considering the fact that the equity markets are down. But this has a performance of negative 22.4% since the beginning of this portfolio, right? So actually very poor performance here, considering the fact that fixed income positions are there really to balance out long-term returns of the equity fluctuations. Well, in this case right now, that is not the case. It also has a fee of 0.22%, and then there's a small gold position in a trust with a fee of 0.1%. All right, let's now go back to this page right here where we can see both the long-term expected growth, that's really just, average estimates, but more important is the account history as well as the recent activity. So let's actually start with the recent activity. If you click here, you can see all of the activity in each one of the accounts or all of them together. So in this case, we've clicked on the main RRSP. So we're seeing only the activity within that account. We can see dividends being received, fees paid. Mostly it's just going to be dividends received because I don't really contribute to this account all too much. And if you click on that, it'll show you from which ETF as well as the amount. So going back now to the account history, well, we can see all of the deposits as well as the account value over time, the fluctuations here. So the account performance in this case, net deposits, I've deposited 14,483, as we can also see right here. And this is the difference between how much I've deposited total to this account minus withdrawals. At this period right here, I'd withdrawn in order to purchase a property. Simple rate of return, negative 4%, as we saw earlier. And then also they have a money weighted rate of return at negative 2.1%. This takes into account the fluctuation of returns depending on your amount of deposits as well as the withdrawals, considering market movements. Now, by looking at this negative 4% total return in this account, even considering the fact that it's been several years that the account's been open, well, this doesn't necessarily seem all too impressive at all for that matter. But I think in order to actually compare the performance of this portfolio to say the S&P 500, we need to look at a more fair and accurate comparison between, again, this portfolio as well as say a 90-10 split between the S&P 500 specifically as well as a long-term bond index as that 10%, making up the 100% in a separate portfolio. So let's take a look at that right now. So straight off the bat here, we can see that the S&P 500 index itself is down 9.24% since March 4th of 2022, whereas this account is down roughly 8.4%, which in theory does also make sense because this account isn't 100% allocated to the US stock market and equities. Rather, it has a portion of its portfolio spread between Canadian stocks, American stocks, international emerging markets, as well as a 10% allocation towards that fixed income. So with that considered, well, this portfolio is actually faring relatively well in this current market correction that we're experiencing. But what would make this comparison a lot more compelling as well to know is whether or not Wealthsimple has been a good option or not is looking at the total returns of the account account since October of 2019, while taking into account the additional contributions over time, because we saw a massive bull run after the March 2020 lows. So to do that, well, we need to break up the returns over the past 2 years or so in the Wealthsimple account into a couple of different sections. The first one, considering that from October 2019 to around March 2021, the account was on a risk level of 4, meaning roughly 50% equity, 50% fixed income. So let's take a look at the returns for that first part. On the net deposits at the time of 5,469, the account grew to 5,960 for growth of around 8.9%. In contrast to this, though, on a 50-50 split between the S&P 500 and the ZFL bond index, to make this even more of an accurate comparison to the Wealthsimple account, because that is the ETF that they use. Well, over that same period of time, the $5,469 contribution would have grown to $6,135, give or take. Now, from March 1st to roughly February 28th of 2021, the account changed to a 90-10 split, right? That's when I ended up changing it from the 4 to the 10 risk tolerance. So with the Wealthsimple account, well, after the new contribution, it grew by around 3.5% from $9,870 to a value of roughly $10,221. Now, on the flip side here, the 90-10 split portfolio between the S&P 500 and ZFL would have grown by roughly 5.6% during this time frame, from $10,064 to around $10,627, including that, $3,929 contribution that we saw on March 1st. It's really at this point in the portfolio's growth that we're seeing the divergence here, where the 90-10 split portfolio has 90% of it only exposed to the US stock market, versus, say, this Wealthsimple account does have exposure to international equities, where we've seen Chinese stocks, for example, specifically contracting massively over the past year or so. But from here, finally, the last stretch, we can see that from March 4th, 2022 to today, the Wealthsimple account went from $15,149 to $13,945, down 7.9%. Now, again, on the flip side, during this period of time, the 90-10 split portfolio would have gone from $15,712 to $14,023, down around 10.75% during that, again, same time frame. So in reality, since October of 2019, all things being considered, the Wealthsimple balance sits at $13,970 roughly, while the fictitious S&P 500 and ZFL ETF portfolio would sit at around $14,023, representing roughly a $50 difference between both of the accounts, and you'd still be down overall regardless. Now, really the big difference though is that period of time that we can see right here, where the account was at a risk level of 4. I missed out on major gains experienced during that period of time, and had that not been the case, had it been on the 10 out of 10 from the get-go, the account wouldn't be negative right now. In fact, it would probably still be up around 10%, even considering the drastic price correction that we're seeing in the markets right now. All right, so let's now speak about whether or not this account has been worth it over the years. And really, this is going to be debatable, because ultimately whether or not this type of service is right or not for you is going to depend on your risk tolerance, your needs as an investor, and really just how passive and hands-off you want your investing to be, right? In the context of this particular account, that RRSP that we just looked over, well, I'm looking for a really hands-off approach to the long-term growth of that RRSP. Specifically, that is a smaller RRSP account that I hold, and also I like making these updates on a yearly basis for everyone who's interested. I'll probably maintain this portfolio for years to come, really just to see where it ends up trending, but in reality, well, I'm aware of the fact that it's not going to beat out, say, the S&P 500. This type of portfolio that's more diversified isn't expected to beat out, say, 100% equity focused portfolio in the first place. And for this RRSP specifically, that's something that I'm okay with. Ultimately though, whether or not any robo ETF provider such as Wealthsimple or any of their competitors is going to be right or not for you really just comes down to your risk tolerance, your investor profile, and the most important is just the level of passivity that you want brought to your investments. Yes, you will be paying a management fee that reflects that level of passivity, but if that's something that you're after and you don't want to think about your investments whatsoever, then this could very well become a good viable option for your needs. Now, if you're an investor though who does want to be more hands-on when it comes to selecting and understanding what's going on within your investment portfolio, then I would highly recommend that you check out the stock market investing course, as well as the dividend growth investing courses, both of which you can find down below in the description, and they're over on Skillshare. So if you create a 1-month free trial, you can access the entirety of these teachings and understand everything about how to properly navigate the stock market, everything you need to know about dividend growth stocks, as well as creating a portfolio that's going to actually reflect over your needs, investor profile, and risk tolerance. So make sure to check both of those out down below in the description. So with that said, I really hope you enjoyed today's video. Drop a like if you did, comment down below anything that you want me to answer, and I'll see you in the next one.